Welcome to Finbot Insights. In 2025, you probably saw the headlines. Bonds were making a massive comeback. But today, we're going to deconstruct that narrative. We will look past the hype and into the cold, hard mechanics to see if that story was ever really true to begin with. This was the number that started it all, 7.08%. It was plastered everywhere, touted as undeniable proof that the bond winter was over and the good times were rolling again. And of course, the financial media couldn't get enough of it. We saw a flood of headlines just like this one. But what we're here to demonstrate is that this celebrated return was in fact a phantom, an accounting illusion created by a unique set of circumstances that simply cannot happen again. So to see what's really going on, we have to look beyond just the 2025 calendar year. The real story unfolds when you examine the entire 18-month period from July 2024 through December 2025. This wider perspective is absolutely crucial. Now, when you look at that full period, the total return was an impressive 9.77%. But here's the critical part. That number is made of two very different components. The majority, 6.20%, came from predictable, boring dividend income. The rest, 3.67%, came from something far less stable, price appreciation. And this is the central question we have to answer. Where did that 3.67% of price gain actually come from? Because the answer reveals exactly why 2025 was a one-off event, not the start of a new trend. You have to understand, bond fund returns aren't magic. They're not driven by market sentiment or media hype. They are the simple mathematical output of five, and only five, mechanical drivers. These five factors right here are the entire engine. Weighted average coupon, the discount or premium to face value, interest rate moves, defaults, and prepayment risk. That's it. Once you grasp these, the rest is just noise. Let's start with the basics. The weighted average coupon is just the average interest rate that all the bonds in the fund pay you. This is your bedrock, the most predictable piece of your return. Next up, the discount to par. Think of this like buying a $100 IOU for $95. You know that at maturity, you'll get the full $100 back. That $5 difference is a pre-programmed capital gain. The third driver is the one most people are familiar with, interest rate movements. It's a simple seesaw. When market interest rates go down, the price of your existing bonds, which have a higher interest rate, goes up. And finally, we have the two main risk factors. A default is when a borrower simply fails to pay you back, which can obviously crush a bond's value. And for certain bonds, like mortgages, prepayment risk is the chance you get your money back too soon, forcing you to reinvest at a lower rate. Okay, so now that we have our toolkit, let's apply this mechanical framework to the 2025 data and see exactly what happened. All right, remember that 3.67% price gain we isolated earlier? It turns out almost all of it came from just two of those five drivers, falling interest rates and a shrinking discount to par. First, let's look at the interest rate lever. During our window, the 10-year Treasury yield dropped from 4.43% down to 4.16%. Now, that may not sound like a huge move, but for a massive portfolio of bonds, that decline provided a very nice but very temporary boost to its price. But this is the real heart of the story. At the start of the period, the fund's bonds were trading at a massive 10.7% discount to their face value. By the end, that discount had shrunk to just 4%. Now listen closely. This didn't create any new value. All it did was take future gains that were already baked in, and pull them forward into 2025. It was like cashing a check early. And understanding that action, that pulling forward of returns, brings us to what is arguably the single most important metric for any bond investor looking into the future. Forget past performance. It is a completely useless indicator. The only number that matters for predicting future bond returns is the yield to maturity, or YTM. This is not an opinion. It's a mathematical fact. So what was the consequence of cashing that check early? This right here. The fund's yield to maturity, its best estimate of future annual returns, collapsed. It went from a respectable 5.1% all the way down to 4.3%. This brings us to the sobering reality for anyone investing in 2026. Your expected return is now that much lower, 4.3%, not the 7% you saw last year. Why? Because the levers have already been pulled. The gains from falling rates are gone. The gains from the shrinking discount are also gone. Those two engines that powered 2025 have simply run out of fuel. The math is transparent, and frankly, it's undeniable. The future for bonds points towards modest, income-driven returns, not the spectacular price gains of 2025. Anyone telling you otherwise isn't selling you a sound investment strategy. They're selling you hope. Now, it is essential to remember that this analysis is purely for informational purposes. It is not financial advice. You must always perform your own due diligence before making any investment decisions. And let me be perfectly clear, you should not blindly trust us. You should not trust any influencer on social media. Instead, place your trust in the one thing that doesn't have an agenda, the underlying mechanics of the market. If you found this deconstruction valuable and appreciate a data-driven approach, we invite you to click like and subscribe to Finbot Insights. We look forward to seeing you next time.